My next guest disagrees, though. Joining us for more is Larry Adam. He's the CIO at Raymond James. Larry, look, we're at session lows across the board right now. The Nasdaq's now down 4%. You know, Tesla's down 50% from the highs. All the growth stocks are blowing up. Can you just start by telling us what's going on here?
Well, first of all, with the call against Europe, I think it's too early to go into Europe. The reason I say that is that if you look over the first 2 months of the year, Europe has outperformed the United States by more than 10%. That's happened 4 times over the last 30 years. And then the preceding 12 months, the U.S. has outperformed each and every time, and on average by about 8%. So I would caution people that it may be a little late to try and get onto that European bandwagon as we sit here right now.
Wait, a little early to get onto the bandwagon?
Yes.
Okay, got it. So you want more proof in the pudding, is that right?
Well, I just think longer term. First of all, if I look at the fundamentals, right, the U.S. is expected to grow double than what Europe is expected to grow. If you look at earnings growth, you're talking about 12% versus 8%. U.S. companies are more profitable. And then if you look from a macro perspective, if we do get these tariff wars, I think that Europe is going to be penalized more than the U.S. And then when I look at other things like lower tax rates here in the United States, when you look at the fact that you have much more value creation, 50% of the world's venture capital money comes to the United States, I think that that has long-term positive repercussions on our market. So I'm not really ready to say that Europe is really has a game changer and it's going to outperform longer term.
Understood. Let's kind of zero in on exactly what's going on with the market right now, Larry. The Nasdaq's down 12% from the recent highs, 4% today. The momentum and growth stocks have all totally skidded. Just kind of explain this to us. How do you unpack it and what do you do?
Well, I don't think it's really unexpected. As we came out with our 10 themes for this year, we talked about optimism overload. We came into the year, everybody was optimistic, right? If you look at business confidence was at the highest level in 2.5 years. Consumer confidence was at the highest level in 3 years. Investor confidence was pretty much at an all-time record high. And as we know, sometimes when you get too far on one side, it sets up for a more susceptible market. And I do think that's what you're seeing right now. I don't think this is out of the ordinary. Historically, we get 3 to 4, 5% or more pullbacks in a given year. This is our first of the year. So we're actually talking about this ultimately providing a nice buying opportunity, particularly in the area that you're mentioning. When you look at the Nasdaq, big cap tech stocks, they're at the least expensive valuations that they've been since 2017, yet they're expected to have the best earnings growth of any sector in the S&P 500, with earnings expected to be up north of 17%. So I actually think it's an opportunity at these levels.
That's interesting because some would say we're correcting from levels we shouldn't have been at in the first place. You know, when you get to the idea of this over-enthusiasm and everybody's buying and the levels that crypto was at or otherwise. But at least in terms of the Mag 7, I'm assuming you're excluding Tesla, maybe you're including it. You think this is a buying opportunity and that they should continue to go back up to those previous highs and higher?
I do. I think that the investment in the technology space remains very healthy. As I mentioned, valuations are at the most attractive level since 2017. I do see some green shoots underneath all of the bad news that's coming out. I would keep in mind that gasoline prices have been down 3 weeks in a row. When I look at interest rates, they continue to come down, so that should help some of the housing-related or interest rate-sensitive parts of the market. Tax refunds, by the way, are 26% higher than they were at this time last year, which should help the consumer. And then I think the Fed is going to be there. We're looking for 2 more cuts this year. The consensus is at 3 cuts, but I think that that's important because not too long ago, people were talking about a hike. So I still think that there's some positive things building underneath the surface here.